Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing booking holding stock so we can determine if it's a buy or a sell. Let's get started with the model. This is a large cap company, 113 billion market cap. They're trading at $3,100 a share, and they have 37 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their revenue dropped a ton in 2020 due to COVID and lower travel. So they did have negative free cash flow. A big improvement in 2021. Up to $2.5 billion of free cash flow. Travel has been booming in 2022 and 2023, so their free cash flow is north of $6 billion. It's almost $6.5 billion in trailing 12 months. Net income is the profit or loss on the income statement. It's revenue minus expenses. It was pretty much a break even in 2020, jumping to $1.2 billion in 2021, $3 billion in 2022. Now it's $4.5 billion. So they're making money hand over fist, this company. Revenue is a sales for the company, and that's tripled from $6.8 billion to over $19 billion, their highest ever. Because a lot of people who are traveling this year are not just traveling to get away this year, they're getting away for the last 3 years because they haven't done much traveling, and they need to visit family or maybe go to certain places they want to see. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $151 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $135 billion. We divide that by 37 million shares. And we get a calculated stock price of $3,600. They're trading at $3,100, so they're trading at a 16% discount. It's a pretty strong buy according to the model. A lot is dependent on travel, and I don't see that diminishing unless there's another pandemic. People should be traveling a lot this year and the next few years. I, on the other hand, never seem to travel, but that's a different story. There are 17 companies in the industry travel services, and if booking has a number in red, they're worse than the median. If they have a number in blue, they're better. They spend $350 million in CapEx, so that's less than the average, higher than the median. The companies that spend a lot in CapEx do so because they buy vessels. Royal Caribbean, Carnival, and Norwegian. Most of these travel companies don't really need to spend much money in CapEx. They have negative equity, so we can't look at their debt to equity ratio. This is not a good industry to invest in if you want a dividend. There's not consistent cash flow, so most of these companies don't pay a dividend. If you want a dividend, invest in a utility company or a REIT. This company generates more free cash flow than any other company on this list. They're the biggest company on this list. When I started working on this video, I was a little shocked their market cap was north of 100 billion. I didn't realize they were that big of a company. We can't look at their price to book since they have negative equity. Equity is assets minus liabilities in the balance sheet. It's the value of a company according to the balance sheet. This implies their liabilities are higher than their assets. We'll look at their balance sheet later and I'll show you. They have a good PE, better than the median average. Their price to free cash flow is between the median average, but their price to sales is worse than the median average. Airbnb is the worst at close to 10. But just because you have a really good price to sales ratio, close to 1, doesn't mean you're a good buy. It just may mean your company may go out of business any day. They have a good revenue growth, 7%, their 5-year annual revenue growth rate. The average is negative 3%. There's some big negatives that are dragging down the average. They released their second quarter results the other day, and they beat earnings by 29%. The expected EPS was $29. They reported $38, and they beat revenue by 5.5%. The expectation was $5.17 billion. They reported $5.46 billion. So they've beat revenue and earnings 4 straight quarters. We'll go through their 10Q in a little bit, but this is the high-level results of their earnings. Their gross travel bookings were $40 billion, up 15% from the same quarter in 2022. That's a popular metric in the travel industry. Gross travel bookings. That's a total dollar value of all tickets. That includes fees and taxes. Room nights booked increased 9%. Total revenue $5.5 billion, up 27%. That's a pretty big number, 27%. 10% growth is pretty solid for this company. 27% is pretty impressive. Net income of $1.3 billion, that's up 51%. But you got to remember, net income is highly influenced by accounting adjustments, so it's not always as reliable. Operating income is a lot more reliable than net income. EPS of $35, up 66%, and adjusted EBITDA $1.8 billion, that's up 64%. Huge improvements. Let's go through their 10Q. This is their income statement, and this is for the second quarter of 2023, the second quarter of 2022. They also show the first half of 2023 versus the first half of 2022. Revenue of $5.5 billion, up from $4.3 billion. Merchant revenue is up a ton from $1.7 billion to $2.8 billion. Agency revenue is up a little bit. Advertising is also up a little bit. When you see merchant revenue, that means the customer pays Booking.com, and then Booking.com gives some of that money to the hotel. For agency revenue, the customer pays the hotel, and that entity gives Booking.com their cut. So you can see Booking.com is really trying to push for merchant revenue. That's why it's up so much year over year. There's lots of pros and cons to both. Let me know in the comments if you want to talk further about this. They spend a lot of marketing, $1.8 billion. That's up from $1.7 billion. Sales and other expenses, $666 million. Personnel costs, $750 million. G&A, $300 million. They have IT cost of $144 million. Depreciation and amortization, $121 million. So total expenses, $3.8 billion. Operating income, $1.7 billion. Up from $1 billion last year. Net income for the quarter, $1.3 billion. EPS of $35 compared to $21 last year. And they bought back a lot of stock. They have 37 million shares outstanding. Last year they had 41 million. Let's look at their balance sheet. They have 19 billion of current assets, 12.5 billion of current liabilities, so their current ratio is about 1.5. They keep lots of cash on their balance sheet, 14.6 billion. Accounts receivables, this is how much money others owe them, 2.8 billion. Their total assets, 27 billion, up from 25 billion. They have 6 billion of deferred merchant bookings. So when you pay for a booking, it goes into the liability section on their balance sheet. It also increases their cash because they can't book the revenue until you go on the trip. And once you go on the trip, then they move some of this dollar amount off the balance sheet and book it as revenue onto the income statement. They do have a lot of debt, 13 billion, up from 12 billion from last year. Liabilities of 27 billion, more than their assets. So that's why they have negative equity. Negative 665 million of equity. And the main reason is because they buy back so much stock. They bought back 36 billion of their own stock. If they didn't buy back all this stock, they would have positive equity. Additional paid-in capital is how much money they raised from selling stock, 6.8 billion. And retained earnings are the sum of all their prior net incomes, 29 billion. Their statement of cash flows is for the first half of 2023. So they generated 4.6 billion of cash flow in the first half, a little more than last year, 4.4 billion. And a big reason for that is 3.1 billion of bookings. Last year they had even more, 4.8 billion. Let's look at the financing section on their statement of cash flows. They bought back 5.2 billion of common stock, a lot more than last year of 2.3 billion. They also added 1.9 billion of debt. Instead of adding debt, they should have just bought back less stock. But maybe they felt their stock price was really low. It was a good value. This makes a lot of sense. They did a reverse stock split. That's why their shares outstanding are so low. They did a 1-for-6. When a company does a reverse stock split, their shares go down. A regular stock split, their shares go up. So if a company had 1 million shares and they did a regular 2-for-1 stock split, after the split, they would have 2 million shares. But if a company had 1 million shares and they did a 1-for-2 reverse split, they would have 500,000 shares after the split. If you put $10,000 into this company 10 years ago, you'd have $33,000 today, which is a pretty good return, a 13% annual return, a 230% total return. Let's take a look at the company on Simply Wall Street. It's trading at $3,000 a share, 109 billion market cap, up 1.7% in the past week, up 59% in the past year. Let's learn a little more about the company. They provide travel and restaurant online reservation and related services throughout the world. They operate Booking.com, which is online hotel reservations. They also operate rentalcars.com as well as Priceline. And as you might already know, Priceline offers many different services: online travel reservation, hotels, flights, rental cars, vacation packages, cruises, etc. They also operate Agoda, which provides hotel reservations, flights, ground transportation, and other activities. They also offer Kayak. They actually spelled this backwards, if you haven't noticed. An online meta search service that allows consumers to search and compare travel itineraries and prices. I use OpenTable. They also operate that. That's an online restaurant booking platform. It also offers travel-related insurance, restaurant management services to consumers, travel service providers, and restaurants. They were formerly known as Priceline Group and changed its name to Booking Holdings in 2018. They were founded in '97, headquartered in Connecticut. The risk they list is high level of debt. They went public in '99, and then after a couple of years, the stock was down like 80-90%, and it really struggled for many years. It finally broke through that slump in 2008 and had a huge bull run since then. It's currently trading at its all-time high. Simply Wall Street's valuation is $3,600. They say the stock is 14% undervalued. 29 analysts price this stock at $3,200. They say it's 5% undervalued. Their trailing 12-month revenue in 2012 was $5.1 billion. And from 2012 to 2019, it just kept going up to $15 billion. Then it crashed down to $5.5 billion in 2021. But it's up a ton since then. It's currently at $19 billion. The forecast is for their revenue to be $25 billion by 2025. They had $1.5 billion of debt in 2012, and they've done lots of acquisitions, so their debt kept going up. It was $9.5 billion in 2017. It came down a little to $8.5 billion in 2020. And then to get through COVID, they took on a bunch of debt. It was up to $14 billion in 2021. Which is where it is right now, at about $14 billion. And you can see their equity was higher than their debt from 2012 up through 2017. Then their equity started going down as they were buying back more stock. Now they have negative equity. But you can see this green line is their cash balance. They have enough cash to pay off all their debt if they wanted to. So the debt isn't too much of a concern when you see so much cash. The CEO's annual salary is $750,000, total compensation $30 million. His tenure as CEO is 6.6 years. In terms of insider activity, there's been buying and selling. 2,000 shares have been purchased in the past year. 276 have been sold. This is just insiders. A majority of the company is held by institutions, 96%, 4% by the general public. Vanguard is the biggest shareholder at 8.5%. JP Morgan owns 1.7%. Invesco owns 0.75%. Their employee count grew from 6,600 to a peak of 27,000. They have laid off a bunch of people. They're currently at 23,000. The ticker trades on the Nasdaq, Deutsche Börse, Zitra, Mexican Bolsa, Santiago, London Stock Exchange, Wiener Bourse, EuroTLX, Lima Bolsa, BATS Europe, and Sao Paulo Bolsa. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.